Welcome back, viewers. You're watching the Savera and I'm Shefali. The US Federal Reserve has reduced its benchmark lending rate by 25 basic points, setting the new target range between 3.75% and 4%. The move announced comes as policymakers face mounting challenges in assessing the true state of the economy amid a prolonged federal government shutdown that has restricted access to key economic data. This marks the second interest rate cut of the year and reflects the Fed's caution attempt to sustain economic momentum while navigating an environment clouded by incomplete information. The decision, backed by a 10-2 vote within the Federal Open Market Committee, lowers borrowing cost below the 4% mark for the first time since late 2022. The rate cut comes at a time when the US government's funding lapses has extended into the fifth week, leading to the temporary suspension of critical data collection and reported activities by several agencies, including the Bureau of Labor Statistics. The lack of official data on employment, inflation, consumer spending, and industrial output has left the central bank operating with only a partial understanding of economic conditions. Fed officials stated that the move was influenced by the elevated uncertainty surrounding the economic outlook. With limited access to government data, policymakers have increasingly relied on private sector survey, corporate reports, and financial market trends to assess the economy's direction. Prior to the shutdown, the economy had shown signs of steady job creation and a gradual moderation in inflation, a stark contrast to the high inflation levels seen in 2022. However, concerns about slowing consumer demand, weakening business investment, and global market volatility have continued to weigh on policymakers. Economists suggest that the rate reduction signals the Fed's intent to provide a buffer against potential economic disruptions and maintain stability in credit markets. Investors and analysts have been closely monitoring the central bank's action for clues about its future policy trajectory, especially amid uncertainty over fiscal development and inflation trends. The Fed's latest decision follows a similar quarter-point rate cut implemented in July, which was aimed at supporting economic growth and signs of cooling momentum. Despite earlier aggressive rate hikes in 2022 and 2023, the rein in soaring inflation, the central bank now appears to be pivoting towards a more accommodative stance to prevent a deeper slowdown. By easing monetary policy, even in the absence of comprehensive economic data, the Federal Reserve has underscored its readiness to respond proactively to emerging risks. Officials have emphasized that policy decisions will continue to evolve in line with changing conditions, reaffirming the central bank's commitment to balancing inflation control with the need of sustained growth and employment. That's all for now in this update. Stay tuned to the Savera. Download the app and follow us on various social media platforms.